way to reconcile the two narratives is that markets are certainly pricing out a recession, right? If you look at market indicators, recessions don't seem to be on the cards. But the way that we see 2023 playing out is that a recession is foretold because we're not out of the woods with inflation. Central banks, including the Fed, will have to power through and push on in terms of rate hikes.
The recession debate heating up, BlackRock laying out two conflicting narratives. Bank of America's Mike Gapen weighing in with his own outlook, writing the following. We see enough momentum in consumer spending to push the start of a mild recession into 2Q from 1Q previously. Mike, I'm pleased to say, joins us right now. So to the second quarter from the first quarter, Mike, great to catch up with you. Let's talk about that subtle shift. What's behind it?
Well, as you said, as you noted, we said that there's just enough momentum in consumer spending. So certainly last week we had evidence, firm evidence, that the slowdown is broadening outside of housing. It's now squarely in the manufacturing sector. But a willingness to use excess saving, a very strong labor market, and maybe some easing in financial conditions has kept the consumer spending. And so we think this week we'll find out personal consumption grew at a 2.5% annualized rate in the fourth quarter, so still very strong. So all of these factors are a tailwind at the moment for spending, so we think that means the expansion goes on a little bit longer. We only moved it back a quarter, so this is not a major change, but we do have to respond to what we're seeing, and right now there's enough momentum that suggests maybe Q1's too early and something closer to the middle of the year seems more likely.
Mike, you pushed this back. Did you change your Fed call alongside it?
Well, we did in the following sense. It seems clear they want to slow down the pace of hikes again. So that, that seems like the obvious change. So we're now looking for a 25 basis point hike in February instead of 50 that we had before. We've kept the terminal the same. The message seems to be we want to slow down, but we are still considering a terminal rate around 5% or above. So we stayed at 5 to 5.25. I think risks around that are balanced. If the economy deteriorates more quickly and inflation continues to slow, maybe they hike and pause in March. But the labor market has been strong, and it's been hard to slow that down. So, you could argue that the Fed may have to even do more than the 5 to 5.25 we're thinking. So it's pretty fluid right now. So we just have them slowing down, but still getting to the terminal just above 5%.
Well, Mike, let's talk about that labour market. 3.5% unemployment. Jobless claims in the last week coming in at 190,000. I mentioned it a little bit earlier this morning. We look at the quits rate. The quits rate still elevated. Job openings still suggesting something close to 2 openings for every unemployed American. Mike, when we get to the second quarter, what do you think those data points look like?
Well, I mean, we have the unemployment rate rising a little bit above 5% at its peak, and so you're likely going to have some job losses to get that. So we do have employment growth slowing, kind of continuing the pace at which it's slowing, and then turning negative for a while starting in the second quarter. So think maybe 3 to 6 months of softness in hiring and maybe some negative payroll growth. So we have that happening now in the second quarter. The labor market's slowing in that direction, but as you note, on balance, things are still pretty tight. And therefore, it suggests the Fed has some more work to do, and it's just going to take longer to kind of remove those imbalances in the labor market.
Mike, do you think there's a growing risk that it gets pushed further out, perhaps towards the end of the year, and maybe not at all this year, given how strong some of those data points are?
That's right. We've always said the main risk to our outlook is that the economy just keeps going, and that it's always pretty difficult to slow down the U.S. economy. And if the Fed's really conscious about trying to soft land this and not overdo it, then I think the risk is in the direction of there's enough saving on balance sheets and there's enough employment growth that just keeps the recovery going. So yes, I think the risk is that we have to push things out as the year progresses. That's true.
So the risk for them, they're trying to balance these two risks of doing too much versus doing too little. A few months ago, overwhelmingly, we were told by Fed officials, including Chairman Powell, they believed that the risk of doing too little outweighed the risk of doing too much. Clearly, they now believe those two risks have come into balance. Mike, the way you look at things, do you think the greater risk now as they slow down towards 25 is that they have to pick things up again in the second half of the year?
I don't think so. I think from here they would just the funds rate would leak higher, 25 basis points at a time. I would be really surprised, for example, if they kept hiking and say the funds rate for some reason was approaching 6%. Would the economy power through that? Probably not. I'd be really surprised if we weren't slowing down with a real policy rate that high. So I think from here they can go in 25 basis point increments and still have plenty of time to kind of let this play out. And if they have to go more, I think they can do that. I think the risk of acceleration would be low. So I would say they just maybe keep going at 25 if that's what the data suggests.
Mike, just a final question from me. Sitting here in London, opening up the Financial Times this morning, the headline on the front page, as you might expect, the Eurozone set to escape recession. We look to China and we talk about the reopening over in China as well. Have you got any thoughts on the kind of growth impulse the United States could import from a better Europe, relatively speaking, and a China that could see 5-6% GDP growth depending on how this reopening goes?
Yeah, I mean, the trade channel in the U.S. is pretty small, so I wouldn't overplay that. I mean, and we've been kind of arguing actually the weaker the rest of the world is, the more that helps the U.S. because gas prices come back down. So I think it's about neutral. If Europe is doing better and China surges in the second half of the year, maybe commodity prices move higher and we don't get relief on gasoline prices anymore. But we would get a modest boost from trade. So I think that actually kind of washes out when it comes to the U.S. We're just not as driven by global growth as other economies.
And Mike, this was great. Hopefully we can catch up again next week around the Fed decision. Mike Gapin there of Bank of America pushing out his call for a recession in the United States from the first quarter out to the second quarter, with a real risk that gets pushed even further out through the rest of this year. And for the likes of Neil Duffer of Renmark, maybe not this year at all, given how things are materialising at the moment. Equities right now, decent day of gains on the cards, maybe up 0.5% on the S&P, on the Nasdaq, up 1 full percentage point. Abby has more. Hey, Abby.
Hey, John. Yeah, we do have the S&P 500 up about 0.5% at session highs on basically a volume that's equal to what it's been over the last 20 days. Not surprisingly, with the gain, we have three of the big heavyweight tech sectors higher: tech, communication services, and discretionary. On bottom, we have real estate, utilities, materials, and healthcare flipping right around. So utilities in the bottom, one of the defensive sectors. One sector that's really outperforming, helping out technology, John, is the chip sector. The SOX is up 2.7%, helped out by Qualcomm and Advanced Micro. Barclays is very bullish on chips, raising price targets and reiterating overweight ratings, John. This sector up 36% since the October low.
Abby, thank you. Up next, your trading diary. About 26 minutes into the session, equities up 0.6%. Let's get the trading diary. US PMI is coming up on Tuesday, plus big tech earnings kicking into full gear with Microsoft after the close, Tesla, IBM on Wednesday, US fourth quarter GDP and another round of claims coming up on Thursday. Finally, PCE numbers and the UMich Sentiment Survey rounds out the week on Friday. From London, that is it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. I'll be with you tomorrow morning. And this is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, January 23rd. Here are the top market stories we're following for you at this hour. Citadel crushes. Ken Griffin delivers record profit last year. He's not alone. The top 20 hedge fund firms rake in over $22 billion after fees. Can that continue? And Elliott goes after Salesforce. The activist investor buys a stake after layoffs and a stock slide. We are going to get the latest. Plus, the bear speaks out. We're going to get the call from Mike Wilson of Morgan Stanley, who says an earnings recession is coming and the reckoning could come soon. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, and this kind of leads us to the overall question, right? You have the economic data. Some of it is holding up like the labor market. Some of it's rolling over. What does that do to top line, bottom line, and margins for these companies?
Okay, let's talk about this because I think this is going to be the narrative going through the next few weeks. Yeah, I hear what you're saying about the data, Alex, but it's only the survey data that I think has rolled over thus far. We're going to get more of that tomorrow in the form of PMIs. So the survey data looks soft. Now, normally, ultimately, you go survey data, hard data, and you basically bake in the reality. But the hard data is not there yet, particularly on the employment front. And at the moment, the employment story is holding up, which I think probably means good top-line growth, bad in the middle for margins, and as you say, that by extension is not good for the bottom line.
And speaking of leading indicators in December, they fell a full 1 percentage point month on month. That is worse than that's worse than estimates, but that is a leading indicator. That is not hard data. And then you're looking at a still pretty solid rally here in the equity market. S&P up 0.6%.
Yeah, you are seeing it in some of the corporate numbers. There's a number of chemicals companies out of Europe today that are seeing the margin squeeze that ultimately is coming down the pike, I think, towards a lot of companies. But it's kind of why, I think, is the question. I think it all, and as we were talking about this last week, it all comes down to what is happening with the labour market. If the labour market holds up, and the US labour market at the moment looks pretty good, then I think we're going to have it's going to be not the trajectory that maybe the bears are after. So this goes to our question of the day, folks, as Alex has already alluded to, and it goes something like this. Will the economy and stocks diverge? Can you have an earnings recession without an economic recession? Can you have a bear market and a soft landing? I think these are the questions we need to try and figure out. So Bloomberg's Mike McKee's joining us to try and answer this question, as is Kruti Gupta. Kruti, from a market perspective, let's start with you. The market is anticipating that we are going to see earnings hit at some point. The timing question, I think, is the real factor here. But let's go to the question of the day. If the employment situation holds up, if the top line holds up, what happens in the margin story? What happens to the bottom line? Can we get that earnings recession with a soft landing?
So the answer to whether or not they can diverge is yes. And a lot of that is simply because of a function of what we've seen in the last really 2-3 years post-COVID. The idea here that if you have bad economic news, it's actually good news for the market because of essentially what the Federal Reserve is going to do as kind of the lender and arguably buyer of last resort. But I think the really big nuance this time around is something that Gina Martin Adams, our Bloomberg Intelligence chief equity strategist, said earlier this morning, actually, which is if you look at what the earnings are telling you on the top line so far, they're beating. But if you look underneath the hood, profitability is the issue here because they are actually missing on the sales front, but they're not necessarily missing on the overlying kind of image. And a lot of that is actually being rewarded by the stock market because on the surface, they are then beating their earnings. Now, a lot of this is also simply because all of last year was so painful for the equity market. So there is a function here that even though you're starting to see the economy kind of catch up to what the stock market has priced in simply as a function of the stock market pricing in the moves in the economy about 6 to 9 months ahead, that's where you see the divergence, simply because the earnings pictures are now recovering, whereas the economy is slowing down. But if you actually look on kind of the underlying basis, the economy is slowing down, the sales are slowing down, so that's where you see kind of the parallels or the synergies between what the market and what the economy is telling you. But again, it really depends on what the investors are going to react to. And right now, they're reacting to the surface level earnings, and that's why that's diverging from the economy.
So, Mike, if you look at sort of the soft data versus hard data, if the hard data starts to catch up with the soft data that's rolling over, then what happens? And is that also a given?
Yeah, it's not a given. And at this point, we don't know for sure what's going to happen. It looks like what we're getting is a slowdown in the economy, but one that's going to be a little different than in previous situations, because normally when you see a slowdown in demand that the Fed has brought on by raising interest rates, you see companies start to cut back and you see less production and you see fewer people working. But the companies out there have had such a hard time finding workers that all the anecdotes are that for the most part they're going to try to hold on to them, which means that consumers are still going to have spending power. It will be interesting to see what the overall spending numbers were for the month of December. On Friday, we know that retail sales were a disappointment, but what about services? And we have to see if that holds up. If that holds up, then it's going to be reasonably good news. The recession story has been that people are going to start running out of money, that we're seeing bank accounts be spent down, that we're seeing credit cards get used a lot more, and so therefore the economy is going to be weaker going forward without the consumer. But if everybody still has jobs, could work.
How long do you think, from here, Mike, how long would you normally expect a slowing economy to show up in the employment data? I looked at last week's claims number, were a real game changer for me. This is not a labour market that is easing up in any shape or form. Certainly that's what the claims data would seem to be suggesting. How long would history tell us that it takes for policy to work on employment? When would we normally expect this to happen, that hit to come?
Well, historically, the long and variable lags have taken about 12 to 18 months. We are seeing a slowdown in the amount of hiring, but what's not clear is whether that's because companies are just sort of pausing on hiring, whether they still can't find enough workers, the labor market is so tight. And what we're not seeing is the unemployment rate go up, companies letting go of people. So either that has to start happening soon, or the soft landing story starts to get more credence.
So, and then that leads to the point of the hoarding labor thing, because there's two ways of looking at it. One, you have a job, so you still spend, so the top line is okay, and therefore companies can manage. On the other side, if you hoard labor, but you don't have the top line, then all of a sudden your margins get squeezed, and how much of that, how many more levers do they have to pull to keep that labor?
Yeah, well, I think this is where this year is kind of the special and the exception scenario to that argument you just made, which is last year, one of the big stories, I'm going to use McDonald's, for example, as kind of a case study here, because one of their big issues when you were looking at their past earnings was the commodity prices were going up, food prices were going up. That was eating into their margins. But then more so than that was the wages that they had to pay their staff, not just in the U.S., but around the world. As you start to see the wages at least stay stable and not grow while the commodity pressures come down, that is actually a positive. So even if you don't see improvement in the wage data or the layoff data or the jobs data, that is still a positive for a lot of these companies. And the stock market will actively respond to that because it's no longer growing in the way that it did in 2022 and arguably 2021 as well. So again, even for it to kind of plateau, that's a good thing.
So Mike, let's wrap this up. We are potentially looking at a soft landing. We are potentially looking at a labour market that is going to hold up. How does the Fed look at this scenario? Because I'm assuming that this is not the scenario they anticipated 6 to 9 months ago. How is the Fed going to view this situation? Are they going to be concerned about it? Is this going to be the scenario that they're looking for? Are they going to lean in on it? I.e., does one of the factors in our equation here change significantly because the Fed feels like it needs to?
It's really going to come down to earnings, not the stock market's earnings, but your earnings. Do we see the average hourly earnings continue to rise at an unsustainable level? If that's the case, because there's still a shortage of people that are available to be hired, then the Fed is going to be concerned and continue raising rates. But if we start to see wage gains fall to an acceptable level at the same time that inflation's coming down, even if the labor market stays strong, the Fed won't worry about that. Chris Waller, Fed governor, was asked about it last Friday, and he sort of said, I'd be very happy if we had that scenario.
See, I think this perfectly highlights just how confusing this market actually is and the reaction function actually is. Guys, thanks a lot. Mike McKee, Kitty Gupta joining us from Bloomberg. Appreciate it. So coming up, more on the question of the day, will the economy and the stocks diverge? And what do you do with it? Mike Wilson, Morgan Stanley, Chief U.S. Equity Strategist and CIO, will be joining us next. This is Bloomberg.
earnings season is here.
Wall Street expecting a bit of an ugly season.
People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit.
Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
And since that October low to the December 13th high, the Dow is up about 21%. The S&P is up about 18%. So there's been a nice recovery. And since then, the market's been consolidating. I think we're making a bottom long-term in this bull market.
That was technical analyst and market historian Ralph Angapora earlier on Bloomberg Surveillance with his technical outlook for stocks. So that sets us up for the question of the day. Will the economy and stock diverge? Joining us now for his take, Mike Wilson, Morgan Stanley Chief U.S. Equity Strategist and CIO. Mike, economy rolls over, stocks hold up. Or vice versa. Stocks hold up, economy rolls over. Can those things happen?
Good morning, Alex. Now, I mean, look, I think if the economy rolls over into a recession, then it's very unlikely stocks will hold up. That's not priced. And the reason why it's not priced is because we don't know the answer yet, right? I mean, there is an opportunity for the Fed to perhaps orchestrate a soft landing, meaning no labor cycle. But that's where we differ, I think, from most people, which is if we don't get a labor cycle because companies are hoarding labor, that's actually going to be worse for margins in the short term. And then secondarily, if you don't cleanse it, you don't really have anything to get excited about. There's no reacceleration then for growth next year. So as bearish as we are on kind of earnings in the near term, we're actually probably more bullish than most on 2024 because we think we're in this, boom, bust, boom environment that we've been talking about for the last several years. And you can't have your cake and eat it too, right? You can't say, oh, well, I'll just look through this valley and then play the next boom. Well, I mean, that's not really, advised. I think if you agree with our earnings call next year, then you almost have to agree with our earnings call this year, and the market won't look through that.
So in terms of how you think this is going to play out, you think this is a near-term phenomenon. You think this is going to happen soon, Mike. Yet at the moment, I'm looking at the soft data rolling over. We're going to get the PMIs tomorrow, but I'm looking at the hard data holding up. I'm looking at the employment data in particular holding up. So which piece of data is going to get the markets to pay attention on the economic front and mark stocks lower?
Yeah, I mean, what it always comes down to is earnings. I mean, earnings is the hard data series that drives stock prices the most. I mean, we've always said that, and we continue to believe that. So we're just trusting our process, which is that, the leading indicators for the hard data is soft data. And the soft data has rarely looked this weak. So you have to be basically assuming it's different this time for the hard data not to follow. And, that's not a position that we want to take, particularly given that we just had a rally over the last 3 months, which has been spectacular. We sometimes get coined with being perma-bears, but last time we called for that rally in October, and we basically got chased off the screen then. So, what's amazing to me is very few people wanted to play that rally in the fall, and now people want to play it after it's already happened. And the last thing I would say about that is what people are getting most excited about are three things. Confluence of China reopening, which is good, and we agree with that. Secondly, gas prices have come down precipitously in Europe, which is maybe keeping them out of a recession, at least in the near term. And then you have the hope for a Fed pivot, which is also our call, that the Fed's going to pause after this next meeting. But the problem is you already priced all those things. The valuation now does not reflect the earnings risk that we still see in the U.S., which is not going to change from any of those three developments.
So, Mike, on that point, Evercore had a note over the weekend that said that a China reopening is in the early innings and could unlock $1 trillion worth in excess household savings. Either you disagree with the number or you think that that's already priced, that amount is priced.
Well, first of all, there's a timing to that. Okay, so there's, $1 trillion is going to come out in the next 3 months, number one. Our intelligence and our sources would tell us that consumer confidence in China is still very fragile. So, yeah, they're reopening, and that's a good thing, and it's going to get there. But the average consumer is still skeptical. They're still a bit scared of the virus, as they should be. They don't know how it's going to play out. There have been increased death rates, et cetera. So it's going to be slow. So that's number one. Number two, I would say, and we've done work on this, we think China's reopening is good for China. It's going to be very good for the Chinese stock market. We're bullish there. But it's not going to necessarily drive revenue and earnings growth in the U.S. And that's what I was saying earlier. China basically is 3% of the S&P 500 revenues. So, even if it is a faster reopening, it's not going to move the needle in the short term.
I guess by extension it might, Mike, and hear me out on this. China reopens, good for Europe. Gas prices coming down in Europe as well, probably add some wind to the sails. European stocks have been massively outperforming. Everybody floods out of the US equity market into the European market, into the rest of the world, basically. Can I kind of join those dots together, do you think? Or do you think that trade has already worked?
Well, no, but that has been our call, right? We've actually centered on Asia as opposed to Europe as the place to be. But, the charts don't lie, right? I mean, they basically are showing the relative strength in EM over S&P as well as Europe over S&P, which is the first time in recent memory that that's happened, and that's real. We think it's a function of a couple different things, Guy. Number one, exactly what you said, that the relative growth profile maybe is improving outside the U.S. But number two, in October, the big tech stocks, almost all of them had a really difficult time with earnings, and the stocks came down sharply. And we think that money is now being reallocated around the world, and that could be persistent. That could take years for that capital to be redeployed in areas of the market, global market, that are much more attractive on a relative basis now.
So on that sense, for U.S. tech, how much money do you think still has to come out of those guys?
Well, we don't know, obviously, but what we do know is that the capital concentration that's occurred over the course of the last really decade has been somewhat unprecedented. Maybe the tech bubble was the only other time. So it'll be persistent, okay, particularly if relative strength continues to underperform. And if you just look at those charts, because you did start off this presentation by looking at technicals, I mean, that's probably the strongest technical I can see, is the relative underperformance of that sector compared to everything else. I mean, it's the mirror image of what we've experienced in the last 7 years. And to think that that's all completed now, I think would be naive.
Okay, well, let's wrap it up with the technicals. What do we think about those October lows? Do you think we go through them? Do you think we have formed a base with them? What is it for the S&P? 3570, circa somewhere around there. Mike, do we go through that, or do we hold with that?
Yeah, I mean, our fundamental work would suggest that we will take out the October lows. I think at a minimum, we will retest those lows. Because what we don't know, Guy, is probably two things. Is we still could have other policy support dynamics. We're hearing about now fiscal stimulus perhaps coming out of Germany and France in sort of a coalition. That could be a positive. The Fed could pause, maybe even cut rates. We'll see later this year. That could be an offset on liquidity that has been a headwind. So, but we think that at a minimum, you go down and retest those lows. Our base case would be 3,300. If it got really nasty, it'd be 3,000. And here's the best news I can give you. If it's going to happen that way, meaning the bad outcome, it's going to be early. It's going to be early part of the year. It's not going to be the second half of the year. If we make it that far, that means we probably did orchestrate a soft landing. At that point, the earnings growth will be turned back up again, and we can look forward.
Okay. That timing's really interesting. Mike, as ever, a fascinating note over the weekend. Always appreciate your time, sir. Thank you very much indeed. Mike Wilson of Morgan Stanley. Okay, still ahead, activist investor Elliott Management targeting Salesforce. We're going to have more on the multi-billion-dollar stake and what it means for the future of this company. That's next. This is Bloomberg.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Spotify is the latest tech company to cut jobs. The streaming giant said today it is cutting its employee base by about 6%. The company has about 9,800 employees. Before today, Spotify stock had fallen 58% since the end of 2021. Microsoft is investing $10 billion over several years in OpenAI, the pioneering artificial intelligence research lab behind ChatGPT. The software giant is looking to tie text and image generating programs to its own products. Last week, Microsoft said it was cutting 10,000 jobs, but noted it would still invest in key areas. And that is your latest Business Flash. Alex?
All right, thanks so much, Ritika. So it is 23 minutes past 7 on the West Coast. Want to get to the startup? We cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg's Ed Ludlow. All right, Ed, let's kick it off here. Is it all Salesforce right now?
Yeah, it's all Salesforce. I mean, we've woken up to the news that Elliott Management has taken an activist position in the company. According to a Bloomberg source, it's a multi-billion-dollar stake. And in the statement, Jesse Cohen, who's managing partner at Elliott, didn't give specifics of the investment, but basically said, you know, they're looking forward to working with Mark Benioff to basically realize some returns, you know, realize the value that they think is there in that company. And Salesforce is just a classic, right? You know, it hit its peak in November 2021. From a share price perspective, it hired like crazy, but the difference is that M&A has been a big part of their story. And, you know, activists look at how that share's been pulled back. We're at half the market cap we were from that November peak, and they want to see returns.
Ed, it all sounds really nice. Everybody's going to get on. It's all going to be fantastic. We're going to do great things here. Really? Is that really what we're after here? One of the key questions here I have to wonder about is whether or not Benioff's head potentially could be on the block here.
Yeah, it's interesting. The limited sell-side reaction that we've seen this morning says, firstly, this is not a surprise, given the trajectory of Salesforce shares, though they've started this new year brightly. Remember, Starboard came in October and basically said something similar, that the return, the value proposition of this stock does not reflect the growth that it's seen in the pandemic era. Well, now you have two activists on board, but what I found really surprising, it was the tone, right? You know, sell-side is saying not just we're not surprised, but actually they think that Benioff will like this. He'll work with the activists to boost profit and shareholder returns.
Hey, Ed, quickly, before I let you go, Elon Musk at court today. Again, what can we expect?
Yeah, so we had our first Taste Friday where he basically said, just because I tweet, it doesn't mean that anyone takes it at full face value. It doesn't mean that, they act on it. We just got into the idea that his tweets are just tweets. What we will get into this Monday is whether or not there was substance behind the claim that he did have funding secured, that there was a package lined up to take Tesla private, and in evidence will be emails and texts with some of those supposed investors who were going to take part.
I'm just wondering how Elon Musk feels about the court artist and the imagery of him.
It wasn't bad.
I wonder whether we'll see some tweets. It was okay, maybe. Ed, great stuff. Thanks very much indeed. Julia Coronado's next. We're going to talk macro policy. This is Bloomberg.
Happy Monday, happy rally. We're about an hour into the trading session here in the U.S. S&P up 0.8. Here's Abigail Doolittle tracking the moves. Hey, Abby.
Hey, Alex. And yeah, we have a nice rally. This is a two-day rally now for the S&P 500. Friday there was the big rally, and now we're popping onto it up about 0.7%. So this year, 2023 so far, starting out really pretty well. Last year, of course, was the first down week for the S&P 500 of the year, but otherwise up, up, and away. As for some of the big movers on the day, it has everything to do with those tech heavyweights that are helping the S&P 500. Apple up 1.9%, Tesla up 4%, Nvidia up 4.3%, Barclays positive on the chips. That seems to be flowing through to some of the other techs. You can also see Salesforce.com up 3%. This, of course, on the announcement that Elliott is taking a stake. So some encouragement there that things are turning around. Things are turning around technically. Let's check in on the S&P 500 because we've been following this chart for a while. Here is the downtrend, the bear market, the last year's bear market. We've seen these many tests of resistance up near the 200-day moving average. We're going back above resistance once again. Now, the more that happens, it tells you that the buyers have conviction. They keep fighting those sellers, suggesting that similar to the Russell 2000, the Dow, and some of the other indexes that have broken higher, the European indexes, we might see that happen for the S&P 500, despite the talk of a recession, despite the talk of the Fed raising rates. One thing that it could have to do with, and this is sort of counterintuitive, but sometimes you see investors looking for these big, broad macro points. So we do have, of course, company after company laying off people. While that is a negative for the people who are laid off, it could be seen as a sign of investors that finally companies are making changes, that it could really help their financial structure. And here are some of the stats on this, Alex. It's counterintuitive, but I've seen this before where after the bad news, that's quite kind of like sell or buy the bad news and maybe the idea that things are going to be improving soon.
Right, but it's like they're not going to hire, but they might not lay off. So the nuance in there also quite interesting. Abigail, thanks very much. And we'll talk about that in just a moment with someone from NABE. Okay, let's go to the broader sense of the different indicators that are talking about recession. So JP Morgan had this great chart that says the odds of an economic downturn have really fallen from the highs that we saw back in October. And according to the firm, you got 7 out of the 9 asset classes, from high-grade bonds to European stocks to U.S. equities, now show less than a 50% chance of a recession. Well, Julia Coronado, Macro Policy Perspectives president, joins us now. She's also the president of the National Association for Business Economics, NABE, and we just saw some of the data there. So we'll get to that in just a moment. Julia, when you take a look at the different data points, is that true? Are we pointing to a world where we may not get a recession, but actually a soft landing?
Well, it's definitely a greater likelihood than it seemed a few months ago. And the main driver is that the supply side of the economy is functioning better. So many indicators and company reports confirm that, yes, we are finally recovering from some of these frictions and disruptions that we experienced over the last couple of years. That's allowing inflation to moderate without a lot of layoffs, as you noted. And it's also delivering a little bit more of a recovery in purchasing power to consumers. So all of that's good news and does suggest that the likelihood that we can achieve a soft landing has certainly gone up in the last couple of months.
Julia, Mike Wilson from Morgan Stanley, good morning, by the way, it's Guy, just told me that history would not be on my side were I to suggest that the soft data we're seeing, and we're going to get more of it in the PMIs tomorrow, does not lead to the hard data. We've got very bad soft data at the moment, survey data. Does the hard data ultimately head in the same direction?
You know, again, the answer there is sometimes it does and sometimes it doesn't. And in particular, PMIs, if you think about what they measure, the fraction of companies growing versus not growing, they're not well designed to capture actual growth. And what we know that we're in the midst of is a substantial and pronounced slowing in growth from astronomical levels, from a super red hot recovery. We are cooling quite quickly down to something slightly below trend. So naturally, those survey measures capture that, quite significant change in environment. That doesn't necessarily translate into hard data that are consistent with a recession. Those two things can be consistent with each other.
So that leads me to the labor market and then the great survey that you guys just did that Abigail fronted for us on that. So if you have firms that feel like it's easier to get workers or they don't need as many workers, they're not going to be hiring as many, is that a signal that the labor market's going to get much looser or that we're going to see layoffs? How do you read that data?
Well, it's possible that we get layoffs, and certainly we're getting layoffs in the tech sector, and they're substantial. But so far, what the claims data, the unemployment insurance claims data suggests is that those people so far are able to reallocate to other sectors or other jobs relatively quickly without a long spell in unemployment. And one thing that we're hearing from firms this time around, which is a change from prior cycles, is that they're more reluctant to let workers go. They're going to be very strategic in their workforce management. They're not going to just quickly turn to layoffs as soon as revenues moderate or get or margins get squeezed. Yep. They're going to hold on to those workers because it was so hard to staff up in the last couple of years that they are really going to be more reluctant to turn to layoffs, and that could be a source of resiliency for the broader economy.
Okay, Julia, you are taking us perfectly to our question of the day, so we'll let you have a little stab at it. Can you have an earnings recession without an economic recession? What do you think?
Yes, I think that's possible. Again, if companies who are facing more price-sensitive consumers and slowing top-line growth do decide to absorb narrowing margins in order to hold on to their workforce through the cycle. Again, this is not a spot management of your workforce. It's more a through-the-cycle management of your workforce. Yes, you could see profits get squeezed. You could see a decline in profits this year and still see resiliency in the job market. So far, that's what we've been seeing.
So if that happens, Julia, and that continues, what kind of economy do we look at on the other side of this? What kind of investing climate do we look at on the other side?
Well, you know, one of the things that depends on is productivity. So productivity in the last couple of years has been abysmal because of supply chain disruptions are a direct hit to productivity. The high turnover that we've been seeing in the workforce is also a hit to productivity. And there's all these incentives that firms have to improve it. If we see a little burst of productivity, that could take us to a second leg of this expansion. There are reasons for optimism here. It's still very early days, but the analogy here would be the mid-90s cycle where the Fed hiked rates very quickly, we got a soft patch, and then we saw a burst of productivity open up a second leg of the expansion. That's an optimistic take on what is possible this year.
Julia, let's take the other side of that coin.
Okay.
Let's say we don't get that productivity push. We're going into the beginning of the next cycle with a strong labor market, which I'm assuming would lead to even more tightness in that labor market and potentially a re-acceleration in inflation.
Well, I don't think that we have central banks that are going to tolerate that. So if there are indications that inflation, and in particular the Fed has its eye on service sector wages and service sector inflation, then they're going to keep hiking. And if they keep hiking and we have that kind of underlying inflationary pressure that isn't being alleviated by improved productivity, then I think we're talking about a recession. Then we're talking about another leg up in interest rates above current market pricing, a tightening in financial conditions, and another leg down in growth. And at the growth rates we're running at, we're going to be talking about declining growth. So that's the other possible scenario, and these are very sort of even odds, I would say, very close to even odds of these two scenarios playing out.
So Julia, we talked to Mike Wilson earlier. He said his base case is, then the bear case would be 33 for the S&P. In a really bad case, you go to 3,000. Based on how you view the economy right now, where's the biggest misprice in the markets?
Ooh, that's a good question. You know, I do think that long rates have rallied a bit hard right now, and maybe will go up on an optimistic scenario. And I tend to put a little bit more weight on that, you know, soft landing scenario than a recessionary scenario. So, you know, then you're going to have more pain in interest-sensitive sectors. There's been some optimism around a soft landing for housing housing. I think even if the Fed is able to pause here, you're talking about a level of interest rates that's double what it was in recent years for things like mortgages. And so there's still, I think, more repricing to come. Even in a good scenario, I think that there's the reality is, why should house prices be so much higher now than they were pre-pandemic, when rates and when rates are just going to be so much higher for a while?
All right, Julia, thanks so much. I'm trying to sell an apartment, so shush. Julia Coronado, Macro Policy Perspectives President. Good to see you. Thank you so very much. All right, coming up, Ken Griffin, Citadel churns out a record $16 billion in profits and one of the history's most successful financial plays. We're going to break down those details next. This is Bloomberg.
Keeping up to date with news from around the world, here's the first word. I'm Rishika Gupta. In California, authorities are trying to figure out the motive for a mass shooting in an Asian community near Los Angeles. 10 people were killed when a gunman opened fire in a ballroom during Lunar New Year celebration. The suspect, described as an Asian male, was found dead of a self-inflicted gunshot wound. Poland will ask Germany permission to send its German-made Leopard tanks to Ukraine. On Sunday, Germany's foreign minister investors said in Berlin were asked about the tanks, it wouldn't stand in the way. The failure to work out an agreement on tanks has overshadowed pledges to send more military aid to Ukraine. And in France, President Emmanuel Macron's government is moving ahead with its pension reform plan despite the threat of more protests. The proposal would raise the minimum retirement age from 62 to 64. More than 1 million people took to the streets last Thursday to protest the plan. More are set for next week. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. So Citadel made a record $16 billion in profits for clients last year, outperforming the rest of the industry, and that gain is the largest annual return for a hedge fund manager, just surpassing the $15 billion that John Paulson generated on his bet against subprime mortgages back in 2007. Joining us now for more is Bloomberg's Wall Street correspondent Sonali Basak. Lots to get through on this one. How did he make the money off of it? Where did it come from?
A lot of different places. Remember, the main fund, it's everything from macro to commodities to equities. And remember, equity funds overall, by the way, the fact that Citadel was able to do better in equities than most people, equities overall, according to Bloomberg's own indices, lost 12% last year. Worst market we've had in many, many, many years. No surprise there. But if you can go short too, you have a little more on your side. Remember, Citadel makes the heartbeat of it is also in quant and technology, and folks that focused on quantitative strategies also did well. So you had a lot in Ken Griffin's favor there. I really have to point out here that that $16 billion return, especially because the greatest trade was really a one-way, one large bet that John Paulson had made, the $16 billion return brings Citadel's gains since inception, the net gains, to $66 billion nearly. So that is well above what Bridgewater has had since its inception, according to LCH, at $58 billion. So it's not even just the one amazing year that Ken Griffin had with Citadel, and by the way, also at Citadel Securities, the market maker, was a blowout year. He's also, over time, now surpassed Bridgewater by the numbers when it comes to dollar gains.
Sonali, what's the fee structure on this fund?
Well, of course, we know that they charge more. Remember, Citadel doesn't only have one fund. They have many funds. So the fee structures will vary. And by the way, I will also say, Guy, they vary across investors for the most part for most hedge funds. I think something to watch through this year is not just the funds, the 2 and 20 or sometimes the 3 and 30 for some of the other big quant funds, is also the different types of funds that are being discussed for talent. The pass-through fees that we've seen at others like Brevin Howard and how much leverage Citadel has with something like that.
So going forward then, what do we look at? So I've been reading how certain hedge funds did well, not all of them, right? Will the stock picker world actually continue? Will that finally happen and it's not just a one-off? Or is it still just going to be, if you do quants, you're in a good shape?
Well, I think what's important here too is remember that Citadel didn't make all its monies in equities, right? So if you look at all of the strategies throughout last year, when you look at the whole hedge fund industry at large, most of them were in the red according to our indices alone. The only one up double digits according to our indices is the commodities funds. So by definition, things are going to have to change this year. I think something that's interesting is, moving away from Citadel for a second, if you're a value investor, if you're a David Einhorn who had a really great year last year, if you're a Cliff Asness that had a really great year last year, Cliff Asness is saying that you're still kind of in early innings in that kind of a trade and cyclical shift in the equities world. I think also very interesting here is not just who made money. Of course, Citadel is the #1 game in town we have to talk about, but think about like a Chris Hone, right, who had lost money for the first time in more than a dozen years, had the worst year since 2008, and so do some of these strategies start to come back? You're talking a lot about Elliott this year, for example, just coming out of the gate with big activist bets again. That by and large wasn't a strategy last year that got you a lot of money. So do you start to see some more strategies that focus on single name concentrated bets start to come back this year as the markets start to become more interesting?
Nevertheless, these are all big funds, Sonali. How important is scale right now? Is that, if you're looking to put money to work in hedge funds, is the equation fairly simple? The bigger, the better?
Remember, how a few minutes ago I was just talking about how Citadel has multiple funds to invest in. And similarly, when you think about Millennium, multiple funds to invest in. D.E. Shaw is another big one up here, now number 3 when you look at the LCH investments kind of, league table here. This long-term trend towards multi-strat with many types of strategies has been kind of where the industry has been moving toward. And there's good reason for it. It's that nimbleness in the strategy. It's that ability to take risk and your investors trusting you more to get into a strategy that they may not have trusted you in before. I think Citadel is an interesting example of this because remember the co-CIO here, the person who's the number 2 under Ken Griffin is Pablo Salome. Came from Goldman Sachs, known to be part of that fixed income trading desk, and it starts to give you different forms of talent that really lend itself to that multi-strategy model. Who moves from the buy side this year, Guy, is of is of high interest to a lot of the industry. Last year when we walked into the year, we knew that it was going to be a tough year for a lot of hedge funds out there. We knew the Citadels and Millennials were picking at the cream of the crop here when it came to the talent pool. But now, guess what? It's really starting to shake out who is making it through this kind of a market and who's not, and performing the function of what a hedge fund is supposed to do for those fees that you're talking about here that only matter when you're looking at returns past 1 year.
It's amazing, isn't it? That multi-year strategy kind of is something you need to really think about. And as you say, does it do what it says on the tin? Are these hedge funds? Sonali, great stuff. As ever, fascinating reporting. Bloomberg's Sonali Basak. Coming up, President Biden wrestling with increasing political fallout after additional classified documents were found at his private home in Delaware. More on that story next. This is Bloomberg.
Justice Department finding more documents containing classified information at President Biden's home in Delaware. They're said to be classified notes from the president's time in the Senate and vice presidency. Here with the latest is Bloomberg's Washington correspondent Anne-Marie Hordern. Seriously?
Yeah, another batch turned up this weekend, an FBI search that lasted more than 12 hours at the president's Wilmington home in Delaware, and they found 6 classified documents. But this just adds to the drip feed of classified documents we've seen coming from the president. And Alex, as you mentioned, not just his time as vice president, but also what we've learned from the lawyers is time at the Senate. Obviously, this is going to be a huge headache. It's just growing, really, for the White House because they really have tried to compare themselves differently and really draw that line that how they are dealing with this is different than the former president, but when documents keep showing up and it keeps becoming headlines, that makes that conversation much more difficult, especially as this president is looking to potentially launch his 2024 bid.
It does feel, Anne-Marie, though, that one cancels the other one out. The Republicans can't go after the Democrats and the Democrats can't go after the Republicans. Is that the right way of looking at it?
Maybe, but that's not how it's being taken or seen here in Washington. I mean, what you have over the weekend is Republicans and even a Democrat, the Senate Majority Whip, Dick Durbin, is out saying, you know, this is embarrassing and this shouldn't be happening. So I think not everyone is going to see it as they cancel each other out. Potentially, this is not the top priority for the American people, and I think a lot of polls would probably show you that, but it certainly is a priority for definitely at this moment, Republicans, especially those in the House.
Well, even some Democrats, though, are critical over this as well, and we also have some shakeups, particularly in the White House Chief of Staff's job, and I'm wondering how many more shakeups do we see as we gear towards 2024?
Well, I think the shakeups is probably just natural for an administration, especially since all of these people, really those very close to Biden, like Chief of Staff Ron Klain, who reporting is he is on his way out, and you're going to have the individuals seeing on the screen now, Jeff Zients, who was the COVID czar. This is normal. These jobs are incredibly tasking on an individual's life, and it is normal to have a shakeup, especially after a midterm election. But it likely could be a little bit more difficult as they are trying to launch a 2024 bid, shakeup in the West Wing, and on top of that, the documents and a fight with Congress about the debt ceiling.
It's busy, certainly busy. Anne-Marie, great stuff as ever. Fantastic reporting, AMH in DC. Okay, let's talk about the markets. We're coming into the end of the day here in Europe, around 35 minutes to go until the end of the day. European stocks continue to push higher. 454, we're up by another 0.5% today. Number of 52-week highs. I'll show you those in just a moment. Euro dollar through 109 a little bit earlier on. We faded that move a little bit. We're still trading quite close to it, 108.67. The Italian yields, we're seeing Italian yields just moving a little bit now. There was a bigger move a little bit earlier on. What you have had today is quite a lot of hawkish speeches coming through from the ECB. We'll talk about that in the next hour as well. What are we going to talk about in the next hour as well? The impact of the IRA, the Inflation Reduction Act, is having here in Europe. Tony Danker, CPI Director General, is going to be joining us to talk about that. How should the UK respond? We saw that Scholz-Macron meeting over the weekend as well, talking about this. It is a big subject in Europe. More to follow. This is Bloomberg. European stocks are at session highs. Breadth looks pretty good. Volume looks a little bit light, but it continues. It is Monday, the 23rd of January. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So here we go, this Monday, this is what the session looks like. 454 on the stock 600, technologies at the top, chemicals are at the bottom. A margin warning in one key chemical company out of Europe may set the tone here. That is why that sector is underperforming, but we're at session highs. The euro's come back a little bit over the last hour or so. The pound is still negative against the dollar, 123.69. We get a lot of PMI data out tomorrow. Pay attention to that. The soft data at the moment quite negative, but it's not translating into hard data, which I think is really interesting. So cable 123.72. Brent crude continues to march ever higher. 88.84 is where we're trading right now. 1.4% to the upside. Again, pay attention to this. This is going to have maybe a potential lead indicator as to what the inflation story is going to be looking like. Driving obviously rolling over a little bit, but nevertheless, we are seeing that as a factor. Maybe that element that we've seen so strongly on the downside for the inflation data we've been seeing of late starts to turn around a little bit. Anyway, Alex, at the moment, stocks continue to push on.
Yeah, same here in the U.S. We're actually making another run at the 200-day moving average here. We're above that level now for the S&P. We broke above that level a couple times last week, couldn't hold it, and then rolled over. Will this time be different? Tech really leading the way here. NASDAQ 100 up almost 2 full percentage points. And a big part of this is what's happening in the semis. So I picked out AMD. Barclays had a nice upgrade all across the board on some of the semis, AMD included. That stock up over 7%. But the why was interesting. AMD poised to take more market share from Intel. Barclays also saying they're pretty positive when it comes to hardware exposure, data center, and PC. So if you have exposure to all those three, they liked you. They also like Seagate, and they also liked Qualcomm as well. Just a quick check in here on the Treasury market. We get a ton of supply this week, about $120 billion worth. And so seeing Treasuries trade a little heavy and yields higher seems to be no surprise. But how we deal on the takedown should also be quite interesting, Guy.
Alex, I bumped into a whole bunch of people that were in Davos last week, and chatting to them, the one thing that really stands out was the amount of interest there was at the World Economic Forum in the Inflation Reduction Act. It was the star of the World Economic Forum. Europe has now got to figure out how to respond. The UK has now got to figure out how to respond. So over the weekend, you get the German Chancellor, who did actually go to the World Economic Forum, meeting with Emmanuel Macron, the French president. They're trying to figure out how they respond. Take a listen to what was said.
It
is necessary that we handle the inflation reduction aid and formulate a European answer. Firstly, we have to make sure that, as a European Union, we are not treated worse than neighboring countries such as Canada or Mexico. And it cannot be accepted that the many local content regulations that are in there cause discrimination of European businesses and their activities in the U.S.
Europe feels like it's been caught really flat-footed when it comes to the Inflation Reduction Act. This thing is law already, and I find that amazing that we're already at the point at which this is now, Alex, embedded on the statute books in the United States. And Europe's kind of scratching its head figuring out how on earth it's going to respond. It probably is capable of responding. How, I think, needs to be decided. And Europe never moves particularly quickly on this kind of stuff.
Well, I also feel it's different in terms of how they're both addressing it. Like, Europe is very much on rules, right? Like, you have to get to zero emissions by this date. This is what the cars have to be like, etc. Versus the U.S. now, which is like, here's a ton of subsidies, and here's some rewards for building these plants. Those are like two very different things. Does Europe able to change what it does in terms of, say, regulation and add some more actual money to it, or is it going to be tax breaks? I'm really not sure.
Historically, there have been a number of countries in Europe that have loved subsidies, but there were rules put in place to try and level the playing field. And I guess Europe's got to figure out the rules how those rules are going to be adapted so that it can put the kind of subsidies to compete in with the United States in place. It's a really tricky thing for Europe to do. And as I say, Europe does not move quickly on this kind of thing. Let's get another view on what is happening here. Alan Katz is Bloomberg's Paris bureau chief. He joins us now to give us a sense of how the French are thinking about this. Alan, the French were early to realize the impact that the Inflation Reduction Act could have. They've been banging the drum. Emmanuel Macron's been banging the drum, talking about the fact that Europe needs to act. Others are now waking up to it. The Germans are now beginning to figure out that they need to take action. We saw this meeting over the weekend. Are we any further forward, though, in actually figuring out what Europe is going to do about it?
Not a little bit maybe, but not really. I mean, you say the French were early to respond. They were sort of, and I say this, I guess I have two hats. I have my American hat and my French hat. I say this with my American hat on. It's surprising actually how late they were to respond to it. You know, as you mentioned in your discussion about this before I came on, this was a bill for a long time in the U.S. and once it was passed into a law, from an American perspective, it's very obvious that very little was going to change. I think it took the Europeans a long time to come to that realization. They're still coming to that realization because in Europe, laws change all the time. It's a parliamentary system. It's quite different. You can just change the law. In the United States, that doesn't really happen. And they're only just now figuring that out. The question about this weekend, the Franco-German summit, did they really make much progress? Well, at least France and Germany seem like they're more on the same line now. They both are talking about wanting to put in big amounts of money. They both want Europe or the EU to come up with a proposal that will allow them to put in a big amount of money to provide subsidies probably for their companies. They are still, I think, a bit worried about a potential trade war. But it is slow coming, but it is finally advancing.
Alan, put on your beret for a second, because something like the labor laws, for example, and how governments deal with industry is also very different than what it does here in the U.S. Can you be pro-union and also like subsidies for certain industries? Like, can all of these things coexist at once?
Oh, totally. That actually is not really a problem. You can be, because in France in particular, it's a very a statist kind of place, right? The French government loves intervening in the economy, whether that's the labor market or with companies. You know, there are a lot of companies that are either state-owned or partly state-owned in France, and they're very happy to give them subsidies. France, like many other European countries, has been reined in by the European Union, which wanted to prevent the wealthier countries in Europe from subsidizing their companies more than the less wealthy countries could do. So France and Germany, I believe, but I can only speak really for France, would be very happy to pour a ton of money into subsidies for companies to build the kinds of factories and the R&D centers that you need for, you know, the future economy, the economy of 2030, the economy of 2050. They would happily put as much money as they need to in that.
Alan, great stuff as ever. Thank you very much. I think you'd look fantastic in a beret. Alex can't do hats, so she's probably
really
a little bit jealous.
I'm just jealous.
Next time I'll wear one.
Okay, we look forward to that. Alan Katz, thank you very much indeed. Well, let's get another perspective on what is happening here. Tony Danker is the Director General of the Confederation of British Industry. He says it's the wrong time for a Tory tax war and that the UK needs to catch up with international rivals with more investment in green energy. This speaks to the same narrative that we've just been discussing. Tony Danker, welcome to the program. If the UK could figure out an Inflation Reduction Act, what would it look like and how quickly could we get there?
Well, look, I think the problem is we don't have the money that Joe Biden has put into the Inflation Reduction Act, nor that Ursula von der Leyen is talking about putting into the European response. So the UK is going to have to outsmart the others. Now, we've been really good at this in Britain for the last 10 years. We've got a very big leadership position in wind. We've used lots of market mechanisms, something called contracts for difference, which is where the government underwrites the risk of the private sector investor. And we're going to have to use some of those assets to compete, because to be honest, there's no way we can catch up with the spending of the Inflation Reduction Act or even the European response.
So, Tony, when you talk to companies, what specifically do they want? Like, would they prefer a straight-up check from the government? Are tax subsidies enough? Do they need other ways to compete and attract financing into the UK out of Europe? Is it more rules? Like, what is it?
Yeah, look, I think what they want is they want upfront government support for the technologies that are essentially pre-commercial, right? So that upfront R&D to get the technologies to be, frankly, affordable, adoptable, dispersible. At that stage, the market will kick in. So that's the first thing. And the second thing they want is, again, what the government did on offshore wind, where they turned around and said, look, there is a wall of green money that wants to invest in these technologies. We need to build the right model that makes it a highly investable proposition, right? So if Mark Carney is right that there is 130 trillion of assets around the world looking to go to the best market that provides a return, Britain has to be good at that bit. We have to make green markets that makes this the best place for the private sector to get return. Now that's hard, given where we've been with windfall taxes and the sort of fallout from the Ukraine war. But I think Britain can have a go at that being the best place to invest your money.
Shouldn't this be, Tony, a Brexit benefit? This is a government that talked about how nimble the UK could become in a post-Brexit environment. Do you think that's the reality?
Yeah, look, I do. I mean, it's been really interesting to watch Ursula von der Leyen at Davos last week say that she's going to suspend state aid rules so the Europeans can do that. If you remember on Brexit, the Europeans fought so hard to make sure the UK couldn't break state aid rules. So I think the commercial reality of these countries is that everybody's fighting for share. But yes, actually, we could be agile and nimble. One of the great challenges we have in Britain, as you'll know, is actually planning laws are incredibly slow. Lots of local politicians don't want to have onshore wind pylons anywhere near their areas. They don't want to have solar panels. They're spoiling the green fields of Britain. And that's getting in the way at the moment because, sure, we can compete on subsidies, but we also have to get much better at planning projects quickly, getting electric vehicle charging infrastructure quickly, getting onshore wind farms quickly. And that, at the moment, is holding up the British response. And I hope the government will crack that thing open in the next year if we're going to compete.
Great point, Tony, and it's the same here in the U.S. You can talk all you want about the funding, but unless you get pipes in the ground, it's a whole different story. We don't have the same kind of worker issue, though, that the U.K. has. What is the best solution to this? How do you manage a workforce that's still not there, even if the money comes in?
Yeah, look, I think this is really tough because British policy making has turned around and said, look, post-Brexit, we don't want to have as much economic migration. Brexit was a vote, really, a lot of it was to do with immigration. And so the government are taking a pretty anti-immigration stance, which means that some of the issues we're dealing with the world over, be it people wanting to stay at home post-COVID, people retiring early, people having long-term sickness conditions from COVID. Yeah, you're right. The British government is going to have incredibly bold answers for that because we're not willing to use immigration to get the skills we need right now. That's why today I put quite a lot of pressure on the government to say, look, whether or not it's childcare to help mums get back into work, whether or not it's the interrelationship between the benefit system and part-time work, the government will need to make some big changes here to, as you say, get skills into the labour market as soon as possible because we're short there, we're not willing to use immigration, and I'm afraid that's not good enough.
Okay, so I hear what you're saying about the government, and clearly there needs to be supply-side reform effectively for the labour market to improve participation. What role does business play in that, Tony? You can't just sub this out to the government. What does business need to do to make this happen?
Yeah, listen, you're completely right. Actually, because we've had labour shortages for the last 18 months in the UK, firms have been trying everything. And some of the reasons why we're coming up with some of the government answers is because some of the stuff that firms are working does face these blockages. But look, I think firms are getting incredibly nimble in trying to work out how do you cope with less labour. Firms, by the way, are definitely in the UK racing ahead on decarbonisation. When I talk to my opposite numbers in countries all over the world, they think British businesses are really miles ahead, probably because of the net zero targets we set early. But as yet, it's not transforming itself into an extended leadership position. There's a feeling that, listen, we've done pretty well as an economy up to this point, but it's getting harder and harder when people like Joe Biden pass legislation like the Inflation Reduction Act.
Tony, look, we really appreciate it. Thank you so much. Great stuff. Tony Danker, Director General of the Confederation of British Industry. Look forward to hearing from you again. All right, coming up, what do you do with an investing situation where you still have a rally underway and the Nasdaq 100 up over 2% and European equity still up as well? Seema Shah, Principal Asset Management Chief Global Strategist, has some insight on the question of the day. Is it time to sell the European rally? That next. This is Bloomberg.
European season is here.
Wall Street expecting a bit of an ugly season. People may be overly pessimistic. We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit.
Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
So it's Monday the 23rd of January. I need to give you some numbers. So year to date, and it is Monday the 23rd of January, the S&P is up by 4.85%. The Euro Stoxx 50 dollar adjusted is up 11.2%. Europe continues to outperform. It has come a long way off the lows we hit sort of October, November last year. So our question of the day is it time to sell this European rally? Well, let's ask that question to Seema Shah, Principal Asset Management Chief Global Strategist. Seema, A, what do you think of the rally in European equities? And B, should we now be selling it?
Hi, Guy. Well, look, it has been a tremendous performance. I think if you think about really asking yourself, what were the key drivers behind this strong performance? I mean, one was obviously the European gas situation has improved beyond what was expected. And the second thing, it seems, is just that China reopening story is proving to be a little bit more robust than, again, many had been expecting. So there are two things there which could be sustained, certainly. So I don't think this is time to sell the rally. But I have to say, we are still questioning how much longer. Is it something that we can see lasting beyond the next 6 months, next year or so? And I think for that, we're still undecided. Mm-hmm. The one thing that really Europe has going for it at this stage is simply its valuations. It's still very, very cheap. So at the margin, if there's any kind of improvement, of course, investors are going to rush for European stocks. The other thing to consider is that if you're doing it from a relative value standpoint, the US is the one which still looks a little bit more challenged. It's still got that economic slowdown still ahead of it, whereas for Europe, it may well be that most of it is behind us.
So if you don't want to be selling it, though, now, can you still be buying it now?
I think you could be buying it in certain areas. You do increasingly see that clients are continuously asking, the big question for them this year is not necessarily are equities going to go down, but it's the kind of the US versus non-US stock story to a level that I haven't actually experienced before. So you do feel like there is some kind of traction, in which case maybe we could see this potentially as a bit of a buying opportunity. Yeah. From our perspective, we are neutral given the various questions I've laid out.
It was interesting what you just said. Never really experienced this kind of interest before. Seema, do you think we've seen a paradigm shift? The last 10 years, certainly since 2008, it has been one-way traffic. The US has outperformed. You and I have had that conversation many, many times. Have we seen a paradigm shift? Yes. Are we in a different environment now?
Well, so I think there is a potential. The reason is that, if you look at over the next 5 years, there is a general expectation that we're not going back to zero interest rates. A general expectation that inflation doesn't necessarily go below that 2% level on average. So from then, you have to think, well, what part of equity stars is going to outperform? Is it going to be growth or is it going to be value? Well, from that perspective, actually, it's a time for value over the next 5 to 10 years. And which region has the greatest exposure to value? Well, it's Europe. So that is one area which could suggest that this is a little bit more sustained, a little bit of a paradigm shift. But the big drawback for me, and this is where I really stop and have to hesitate, is, you were just discussing it before, Europe is a very, very slow mover. Any regulation changes, any kind of novel ideas, it takes a very, very long time. And unfortunately, I think that will work against Europe over the next couple of years. And unfortunately, whereas, for a long-term investor, you want to have a long-term view, I think for Europe, it is almost a kind of a take quarter by quarter at this stage.
Okay, so then for the medium-term view, where is the better place to put? I mean, is it EM? Because we've also been asking the question that if U.S. actually rolls over, at some point it's going to take everyone else with it.
Yeah, absolutely. And again, this is another thing that we've been trying to weigh up is that for emerging markets, the China reopening stories, of course, is fantastic. But inevitably, if you do get a US recession and the Fed is not cutting interest rates, that is a big negative for emerging markets, and it's something that we would expect them to really struggle with. But then look, if you're looking at over the next year, and I have to say, although we're expecting a recession in the US, we don't think it's going to be particularly deep or prolonged. So if you're looking at over the next year or so, maybe this is a good time to be increasing your exposure to emerging markets on that longer term perspective, and knowing that, at least there's a strong growth story out there, especially if the Chinese government is genuinely willing to put in place some of the regulatory, structural reform, stimulatory changes that would be needed to sustain growth.
Let's just focus on the US for a moment, though. We were talking to Mike Wilson in the last hour, and the question we posed to him, Seema, was, can you have a profits recession without an economic recession? What do you think of that?
Yeah, we've been doing the same analysis as everyone else, because obviously the economic growth numbers have been surprising to the upside. Well, look, historically, yes, it's typically, if there is a recession, an economic recession, the earnings recession is that much worse. But you have had circumstances where there has been an earnings recession without that economic downturn. And typically it happens when there's three situations. One is that oil prices have gone up meaningfully. Two is that the dollar has strengthened very meaningfully. And the third thing is that the Fed has hiked fairly aggressively. So those are three conditions that have been met. So we do think that, I think maybe you could say that there's a borderline question of a soft landing in the US. And you look at the labor market, it looks like a potential. But for the earnings story, it does certainly seem that the slowdown is going to be deeper than what markets are currently expecting.
Right, the whole what happens to the economy versus actual earnings. Great stuff. Seema, good to see you. Thanks a lot. Seema Shah, Principal Asset Management Chief Global Strategist. Thank you very much. This is Bloomberg.
So we're about to wrap up the European equity session. 5 minutes to go. It's time for the last call. A look at some of the more influential stocks and analyst notes. Citi out with a really nice note, I thought, on Rémy Cointreau. They're talking about a sizable re-rating. This is on the China reopening story. Remember, later this week, you get names like LVMH. Pay attention to what's going to happen in the luxury sector. Europe has been driven in no small part by that trade. They've got a buy on it. They've got a 200 rating. 179 is where we're trading right now. So there's a potential upside there. They see a sizable re-rating. Let's talk about what is happening in the chemical sector today. Symrise is a chemicals company that is really dragging the whole industry lower today. The stock is down by 5.22%. As you can see, the gap lower first thing this morning. The reason for it is basically a margin squeeze. And this is something that I think the whole of the whole of this industry and most industries are going to be looking for. Are you going to see margin squeeze this earnings call, this earnings season, and what are the calls going to look like? And I think this could be a useful early indicator. Juventus cut at Chevron. The stock is down heavily today. It's actually, I think, less to do with the cut and more to do with the fact that they have been fined, I think it's 15 points by the regulator, and have now been moved down to 9th in Serie A. Accounting irregularities, the reason for that. And then finally, I just want to wrap up. 52-week highs today. Lufthansa, Rio with a really strong move there. BBVA, Holcim as well in the construction sector. Some really interesting names continuing to power this European rally. The European close is coming up next. This is Bloomberg.
Great questions.
So the rally continues. Monday the 23rd of January. It's been a very solid January, and today no exception. FTSE's up by 0.5%. Miners are having a relatively good day. CAC's up by around 0.6%. DAX in Germany up by around 0.5%. We continue to add to the gains. There was a little bit of a sell-off at the back end of last week, but nevertheless we've come through to the beginning of this week, and we're not too far off session highs, if I'm being honest. We're up by around 0.5%. Session highs hit around 10-15 minutes ago, trading 454 spot 61. The sector breakdown, I think, is quite interesting today, though. And we may be getting an early look at the earnings season, which I think is fascinating. So technology doing relatively well today. You've got some of the chip stocks doing okay. The car sector's bouncing back. Real estate yield story. Basic resources, Rio Tinto at a 52-week high. Bottom end, though, insurance and chemicals. Now, chemicals I think is interesting here. So let's move on to the single stocks and just show you what is happening there. Because what you've got here is Symrise, the German chemical company, warning on margins. And that stock has been marked down quite sharply on the back of that. It's actually off its lows. We're now down to about 2.67%. But it's that margin story that you are going to hear about time and time and time again as we work our way through this earnings season. And how different sectors react to it, I think, is going to be interesting. Juventus down by 4.94%. The accounting fine, probably the biggest factor there, though we have seen a downgrade, as we were mentioning just a moment ago. And I just want to bring out what's happening in the mining sector once again. 52-week highs. There's a bunch of 52-week highs today once again. European stocks continue to power higher. Rio, I think, is an interesting name, up by 0.7%. So that was today. Let's talk about tomorrow. Let's get you set up for what you need to know about what is going to be happening tomorrow. So tomorrow morning, first thing in the morning, you're going to see GfK consumer confidence data. Keep an eye on the consumer. The labour market is solid. What does that tell us about the nature of the economic slowdown that we're seeing? If we continue to see the consumer looking good, that could be the soft landing we're talking about. AB Foods, again, kind of speaking to that same sort of narrative. AB Foods, the Western family, owner of Primark, going to be, again, a useful indicator as to what is happening with the UK consumer. Then we get into the data. Now, this is where I think life gets really interesting tomorrow. Tomorrow's one of the real key days of this week. You get Euro area flash PMIs, you get UK PMIs. We've already been discussing that throughout today. So what we've been seeing, Alex, is the soft data, and it's slowed down quite considerably, not translating yet into the hard data. Now, Julia Coronado said the two are not necessarily one follows the other. Mike Wilson took a slightly different view. So that's what you want to pay attention to tomorrow. We also get US PMIs. I think we're going to be spending a lot of time talking about this tomorrow.
Yeah, so this is a prelim read. And just to go over some of the expectations for the UK, for example, UK manufacturing looking at 45.5, which would be a slight improvement, but services still below that 50 mark and deteriorating just a touch, and the composite deteriorating just a touch as well. And for the US, as you were mentioning, also key as well. Going to get the color on the labor market, etc. Let me just pull it up right here on my terminal. For the U.S., we're looking at services coming in 45.2. That's not great, but it is a little bit better than we had before. The composite 46.4. And